September 2008, the bankruptcy of the U.S. investment bank Lehman Brothers and the collapse of the world's largest insurance company, AIG, triggered a global financial crisis.
Gripped markets overnight with Asian stocks
fell off a cliff, the largest single-point drop in history.
Share prices continued to tumble in the aftermath of the Lehman collapse.
The result was a global recession, which cost the world tens of trillions of dollars, rendered 30 million people unemployed, and doubled the national debt of the United States. This crisis was not an accident. It was caused by an out-of-control industry. Since the 1980s, the rise of the U.S. financial sector has led to a series of increasingly severe financial crises. Each crisis has caused more damage, while the industry has made more and more money. After the Great Depression, the United States had 40 years of economic growth without a single financial crisis. The financial industry was tightly regulated. Most regular banks were local businesses, and they were prohibited from speculating with depositors' savings. Investment banks, which handled stock and bond trading, were small private partnerships.
In the traditional investment banking partnership model, the partners put the money up. And obviously, the partners watched that money very carefully. They wanted to live well, but they didn't want to bet the ranch on anything.
Paul Volcker served in the Treasury Department and was chairman of the Federal Reserve from 1979 to 1987. In the 1980s, the financial industry exploded. The investment banks went public, giving them huge amounts of stockholder money. People on Wall Street started getting rich.
I had a friend who was a bond trader at Merrill Lynch in 1970. 1986, he was making millions of dollars and thought it was because he was smart.
The highest order of business before the nation is to restore our economic prosperity.
In 1981, President Ronald Reagan chose as Treasury Secretary the CEO of the investment bank Merrill Lynch, Donald Regan.
Wall Street and the president do see eye to eye. I've talked to many leaders of Wall Street. They all say we're behind the president 100%.
The Reagan administration, supported by economists and financial lobbyists, started a 30-year period of financial deregulation. In 1982, the Reagan administration deregulated savings and loan companies, allowing them to make risky investments with their depositors' money. By the end of the decade, hundreds of savings and loan companies had failed. This crisis cost taxpayers $124 billion and cost many people their life savings.
It may be the biggest bank heist in our history.
Thousands of savings and loan executives went to jail for looting their companies. One of the most extreme cases was Charles Keating.
Mr. Keating, you got a word?
In 1985, when federal regulators began investigating him, Keating hired an economist named Alan Greenspan. In this letter to regulators, Greenspan praised Keating's sound business plans and expertise and said he saw no risk in allowing Keating to invest his customers' money. Keating reportedly paid Greenspan $40,000. Charles Keating went to prison shortly afterwards. As for Alan Greenspan, President Reagan appointed him chairman of America's central bank, the Federal Reserve. Greenspan was reappointed by Presidents Clinton and George W. Bush. During the Clinton administration, deregulation continued under Greenspan, and Treasury Secretaries Robert Rubin, the former CEO of the investment bank Goldman Sachs, and Larry Summers, a Harvard economics professor.
The financial sector, Wall Street being powerful, having lobbies, having lots of money, step by step captured the political system, both on the Democratic and the Republican side.
By the late 1990s, the financial sector had consolidated into a few gigantic firms, each of them so large that their failure could threaten the whole system. And the Clinton administration helped them grow even larger. In 1998, Citicorp and Travelers merged to form Citigroup, the largest financial services company in the world. The merger violated the Glass-Steagall Act, a law passed after the Great Depression which prevented banks with consumer deposits from engaging in risky investment banking activities.
It was illegal to acquire travelers. Greenspan said nothing. The Federal Reserve gave them an exemption for a year, and then they got the law passed.
In 1999, at the urging of Summers and Rubin, Congress passed the Graham-Leach-Bliley Act, known to some as the Citigroup Relief Act. It overturned Glass-Steagall and cleared the way for future mergers.
Markets are inherently unstable, or at least potentially unstable. And appropriate metaphor is the oil tankers. They're very big, and therefore you have to put in compartments to prevent the sloshing around of oil from capsizing the boat. The design of the boat has to take that into account. And after the Depression, the regulations actually introduced these very watertight compartments. And deregulation has led to the end of compartmentalization.
The next crisis came at the end of the 90s. The investment banks fueled a massive bubble in internet stocks, which was followed by a crash in 2001 that caused $5 trillion in investment losses. The Securities and Exchange Commission, the federal agency which had been created during the Depression to regulate investment banking, had done nothing.
In the absence of meaningful federal action, and there has been none, and given the clear failure of self-regulation, it has become necessary for others to step in and adopt the protections needed.
Eliot Spitzer's investigation revealed that the investment banks had promoted internet companies they knew would fail. Stock analysts were being paid based on how much business they brought in, and what they said publicly was quite different from what they said privately.
InfoSpace, given the highest possible rating, dismissed by an analyst as a piece of junk. Excite, also highly rated, called such a piece of crap.
The defense that was proffered by many of the investment banks was not, you're wrong. It was, everybody's doing it and everybody knows it's going on, and therefore nobody should rely on these analysts anyway.
In December 2002, 10 investment banks settled the case for a total of $1.4 billion and promised to change their ways. Beginning in the 1990s, deregulation and advances in technology led to an explosion of complex financial products called derivatives. Economists and bankers claimed they made markets safer, but instead, they made them unstable.
Since the end of the Cold War, a lot of former physicists, mathematicians decided to apply their skills not on Cold War technology, but on financial markets. And together with investment bankers and hedge funds.
Creating different weapons.
Absolutely. As Warren Buffett said, weapons of mass destruction.
Regulators, politicians, and business people did not take seriously the threat of financial innovation on the stability of the financial system.
Using derivatives, bankers could gamble on virtually anything. They could bet on the rise or fall of oil prices, the bankruptcy of a company, even the weather. By the late 1990s, derivatives were a $50 trillion unregulated market. In 1998, someone tried to regulate them. Brooksley Born graduated first in her class at Stanford Law School and was the first woman to edit a major law review. After running the derivatives practice at Arnold & Porter, Born was appointed by President Clinton to chair the Commodity Futures Trading Commission, which oversaw the derivatives market.
Brooksley Born asked me if I would come work with her. We decided that this was a serious, potentially destabilizing market.
In May of 1998, the CFTC issued a proposal to regulate derivatives. Clinton's Treasury Department had an immediate response.
I happened to go into Brooksley's office, and she was just putting down the receiver on her telephone, and the blood had drained from her face. And she looked at me and said, that was Larry Summers. He had 13 bankers in his office. He conveyed it in a very bullying fashion, sort of directing her to stop.
The banks were now heavily reliant for earnings on these types of activities. And that led to a titanic battle to prevent this set of instruments from being regulated.
Shortly after the phone call from Summers, Greenspan, Rubin, and SEC Chairman Arthur Levitt issued a joint statement condemning Bourne and recommending legislation to keep derivatives unregulated.
Regulation of derivatives transactions that are privately negotiated by professionals is unnecessary.
That pretty much exempted derivatives from regulation.
They are unifying markets, they're reducing regulatory burden. I believe that we need to do it.
It is our very great hope that it will be possible to move this year on legislation that in a suitable way goes to create legal certainty for OTC derivatives.
I wish to associate myself with all of the remarks of Secretary Summers.
In December of 2000, Congress passed the Commodity Futures Modernization Act. Written with the help of financial industry lobbyists, it banned the regulation of derivatives.
Once that was done, it was off to the races. And the use of derivatives and financial innovation exploded dramatically after 2000.
So help me God.
So help me God.
By the time George W. Bush took office in 2001, the U.S. financial sector was vastly more profitable, concentrated, and powerful than ever before. Dominating this industry were 5 investment banks, 2 financial conglomerates, 3 securities insurance companies, and 3 rating agencies. And linking them all together was the securitization food chain, a new system which connected trillions of dollars in mortgages and other loans with investors all over the world.
30 years ago, if you went to get a loan for a home, the person lending you the money expected you to pay him or her back. You got a loan from a lender who wanted you to pay him back. We've since developed securitization, whereby the people who make the loan are no longer at risk if there's a failure to repay.
In the old system, when a homeowner paid their mortgage every month, the money went to their local lender. And since mortgages took decades to repay, lenders were careful. In the new system, lenders sold the mortgages to investment banks. The investment banks combined thousands of mortgages and other loans, including car loans, student loans, and credit card debt, to create complex derivatives called collateralized debt obligations, or CDOs. The investment banks then sold the CDOs to investors. Now, when homeowners paid their mortgages, the money went to investors all over the world. The investment banks paid rating agencies to evaluate the CDOs, and many of them were given a AAA rating, which is the highest possible investment grade. This made CDOs popular with retirement funds, which could only purchase highly rated securities. This system was a ticking time bomb. Lenders didn't care anymore about whether a borrower could repay, so they started making riskier loans. The investment banks didn't care either. The more CDOs they sold, the higher their profits. And the rating agencies, which were paid by the investment banks, had no liability if their ratings of CDOs proved wrong.
You weren't going to be on the hook, and there weren't regulatory constraints. So it was a green light to just pump out more and more and more loans.
Between 2000 and 2003, the number of mortgage loans made each year nearly quadrupled.
Everybody in this securitization food chain from the very beginning until the end, they didn't care about the quality of the mortgage. They were caring about maximizing the volume and getting a fee out of it.
In the early 2000s, there was a huge increase in the riskiest loans, called subprime. But when thousands of subprime loans were combined to create CDOs, many of them still received AAA ratings.
Now, it would have been possible to create derivative products that don't have these risks, that carry the equivalent of deductibles, where there are limits on the risks that can be taken on, and so forth. They didn't do that, did they?
They didn't do that, and in retrospect, they should have done.
So did these guys know that they were doing something dangerous?
I think they did.
All the incentives that the financial institutions offered to their mortgage brokers were based on selling the most profitable products, which were predatory loans.
If the banker makes more money, if they put you in a subprime loan, that's where they're gonna put you.
Suddenly, hundreds of billions of dollars a year were flowing through the securitization chain. Since anyone could get a mortgage, home purchases and housing prices skyrocketed. The result was the biggest financial bubble in history.